What's up, guys? And we're back with episode 3 of the Real Estate Professors. I'm your host, Sang Kim. It's my man, Ed, breaking windows Park. And if you guys didn't notice, we're in the same clothes. So we're just kind of going off of our last episode of rental properties and residential. We're going to dive into commercial. But before we do that, Ed, why don't you kind of tell us what trips you got going on next?
Yeah, so we're making money hand over fist here. So my wife and I are booking a trip to Canada.
He's not bashful at all, guys. Man.
This is what we do.
This is what we do.
Yeah, this is why we're in real estate.
Oh, man.
So we're going to book a nice, lovely trip.
Next episode, I promise we'll keep it a little more humble for you guys.
Yes. But humbleness is my greatest gift in life. But anyway, we're planning a trip to Banff, Canada for my wife's 40th birthday, and it's all possible because we have residential and commercial real estate.
Hey, and we actually, me and my wife might show up there and surprise them, which he hates the idea of that. But no, we're actually going to, thanks for asking, by the way. But
yes.
Yeah, we're actually, as soon as I'm done with my project I got going on right now, we're gonna take a long 2-week road trip through Arkansas, Alabama, Georgia, Florida, and then stop for a few days at the happiest place in the world, Disney World. And then swing by Destin, Florida, one of our favorite places to go within the States. Amazing beaches over there. So this episode, guys, we're gonna kind of dive into getting into commercial real estate properties, how you identify them, what are the advantages of them, some of the tax benefits, how you're supposed to get into them through lenders and some of that other stuff, and share some of our experiences through our commercial properties and some of the hurdles that you have to kind of tackle in the processes of how these cash flow great after you've identified some of these properties. So Ed, why don't you kind of start us off with one of your commercial properties and how you're managing it, how it's going for you?
Yeah, no, I have a daycare center. That's the tenant inside our commercial property. Our cap rate is actually a shocking 18%.
Whew.
Yeah, it's a pretty high.
Astonishing number, guys.
Yeah. So we have a single tenant in there. It was a great tenant to begin with. We had some issues with her. So the management part of it has been a little bit challenging. We had some repair costs that came up that we had to sort of go back and forth with her to see who was responsible for it. So there's a lot of legwork on the back end that a lot of first-time investors aren't as familiar with.
It's very hard to deal with these things, guys, especially with Ed. I think his property's out of state. So, I know that it's probably out of state. So you have to have the management in place. You have to have subcontractors and workers in place for repairs and things that have come up with his property. And these are all things that you'll get into conflict with your tenant, especially if you don't have it well written out in your lease and things like that. But I'm sorry to interrupt, but why don't you go ahead and continue?
Yeah, so that's a good point. So we acquired this property with the tenant inside. Most of the leases for commercial range anywhere from 5 to 10 years. Ours happened to be a 5-year, and they extended for another 3. So we got on the back end. So we'll probably actually end up getting a new tenant there. Really depends on how the relationship goes with their current tenant, but the rental's great. Again, it's an 18 cap rate. We'll probably go higher once we get a new tenant in there. We're going to switch it over to a triple net lease, meaning property taxes, capital expenditures, everything's pretty much covered by the tenant. It makes a stronger lease, less headache for both parties because everyone knows what's going to be accounted for and responsible for. So it's just a lot of small to larger pitfalls that you come about operating because it's basically a business that you need to. There's 2 parties involved, and both are trying to negotiate and be on good terms. But sometimes there's stuff on the lease that's not as clear cut. So that's why we're going to do a triple net on the next one.
Right. And kind of segueing into that, what a triple net is basically what the tenant covers. Yeah. So Some are double net, some are just single nets. And so it's just how your lease contract is written. So one of the great advantages of commercial real estate, and this is why we diversify our real estate portfolio with commercial and residential, is that with commercial, there's a certain level that you can just kind of push onto your tenant should you choose to. And another great advantage is that their leases are way longer. So your standardized lease, typically in a commercial, is 5 years with another 5 at the end. And if you're lucky enough, because I have two triple net tenants that have a 5, a 5, and a 5. So I have them hooked for 15 years. And as a corporate tenant, they cover everything. They cover everything except for, let's say that the structure just completely collapsed on them. So they cover HVAC, they cover anything with inside the structure. All I do is basically I actually don't cover much, guys. So they cover property taxes. They reimburse me property taxes. They reimburse me for insurance. And I just only have to do structural repairs like parking lot, and I'm liable for things like that. But that's the beautiful advantage of commercial real estate is the triple net and the longer lease terms. And you can really, really depreciate these assets to where you just write off a ton of your income. So, and they're called K1s on your tax statements. And so this is kind of some of the stuff that me and Ed discuss a lot while we're at the dinner table sometimes with our families, is how we go around through some of these tax benefits that we've learned over the years through our CPAs. And now we're kind of handling even the tax portions on our own. I know Ed does. And so I get with my CPA a lot on how we can write off this and write off that. Like I've gotten into even putting my wife on Schedule Cs within my LLCs and things like that. So, and it kind of writes off a ton of her like expenses, especially if you purchase a new car that's over 6,000 pounds. Ed was considering doing that because he had a substantial amount of income last year from real estate. So he was looking into buying a car over 6,000 pounds using the Section 179 tax code, guys. We could get into that different episode. We're not going to get into that through this commercial episode. But so Ed, when it comes to investing in commercial real estate and how you get into the properties and identifying them, why don't you kind of walk us through how you do that?
Yeah, so a couple things that I look for are economic growth, population growth, rental rates, occupancy rates, lease terms, potential for value appreciation.
Big one.
Yeah, and then any like risks and challenges that we have. So the daycare that we acquired last year, it was in an area that's bustling. And when I say bustling, meaning like high foot traffic.
That's strictly a Baltimore term, guys.
Yes,
We do not use that in Texas. Let's not. Anyways, yeah.
Yeah, high foot traffic, major commercial strip. I look for good tenants and anchors that are surrounding that area. So there's like a CVS, a major grocery store. So you know that the area is well established. You know, it's a safe area. You know, people come to do shopping. There's a lot of other tenants on that strip. We toured the area. A lot of them were lively. There were new tenants coming in, so they're doing TI improvements there. So that's sort of like just a subjective things that we look for. When you get into like more of the nitty gritty, we looked at the lease terms on this tenant, how long they've been there. This tenant survived COVID as a daycare facility, so then we knew the owner and operator were resilient, so we knew that if they could survive COVID as a daycare, then they could probably survive anything. So the rents were on time. We didn't see any major risks there. When we got into the property, we did have to redo the roof. Didn't cost us that much because we got a great contractor that we've worked with for many years. So yeah, no, overall we've been very pleased on the property. Again, we may or may not re-sign. There's a lot of daycare operators in Baltimore City that are willing to come in. So it really depends on the negotiation that we'll probably have in the next couple of months with the tenant. With that being said, let's talk about financing options with Sang, because he likes to leverage.
I do like to leverage, guys. I am more from the format of Rich Dad Poor Dad. Shout out to Robert Kiyosaki. I wouldn't be in real estate without that guy. Really big influence in my life. I, read Rich Dad Poor Dad 20 years ago now, probably in my early 20s, and it's kind of changed my life and how I see things in perspective. And bank leverage is one of them. He's big on that. So is Donald Trump. So is a lot of real estate moguls. I know Ed likes to get into his properties and cash, and that's fantastic. He's more from the school of Dave Ramsey. Shout out to him too. But both great guys, both great follows. I'm not saying one is better than the other, but I do think at some point I would try to convince Ed once his property appreciates to a certain extent. Like, let's say that his property has doubled because the area has grown and it's bustling, as he likes to say. But once it doubles, let's say it doubles, and just take it to the bank and then pull your equity back out, go buy another property. And then use bank leverage so that you obtain more properties over time and have your tenants pay off those properties over time, because we're not here for 1 or 2 years, guys. When you buy a property, I mean, you're in there. You're in there. I mean, these are 5, 10, 15-year, 20-year plays, guys. I mean, 5-year minimum plays. You know what I mean? So we're not thinking short term here, guys. So one of the reasons why I love bank leverage is because, I'm not actually pulling out the money out of it anytime soon. And so that doesn't mean try to put the minimum down, because I ran into a statistic the other day where banks are actually lending 60% less year over year than they were last year. So like this goes for mainly commercial right now. It's a little bit of a shaky time right now within the commercial space, because I watched on one of these other guys that I follow, there was a $240 million high-rise in San Francisco office building that is now selling for 80% below what it was asking for 2 years ago. So you can buy it 20 cents on the dollar. And more, it's heading that way. So I'm not trying to put fear in you guys, but what I'm saying is there's going to be a lot of great opportunities coming up within the commercial space. If you all have some cash and obviously some people to invest in with, that you trust, and such as us. But no, there's going to be some great opportunities, and bank's not going to actually lend very easily unless you're a credible and you have some history with the bank. I have good relationships with several lenders because I've done land deals, land equity deals, I've done commercial deals, I've done all sorts of deals, just regular financing, conventional financing. So we have several lenders that we work with, and it's a great way, really. It's a great tool, guys, without having to put, let's say you have $100,000 that you have investable. You don't have to put the full $100,000 down. Go put $50,000 down, and then go use bank leverage to where your tenant pays, and then over time, go refinance that property and have it cash flow better for you, or go put it into another property. So that's why I love bank leverage. In another video, I think when we have more time, I'll get into how you can actually pitch your lender or these banks better on how you can get approved faster. We're not going to do that this episode because that's like a whole nother episode that I can get into. So that's kind of the reason why I like leverage, is you can get into more properties quicker, even though you're playing a long game in real estate. So with that being said, why don't you share some of the things that have worked for you, some of the tips that you've learned, I guess, that you can share with our audience on getting into commercial and why they should get into it?
All right, guys. So just to summarize, for investing in commercial real estate, there's a couple tips that we have in mind here. You always want to do your due diligence. I think that's paramount.
First and foremost, guys.
Yeah. So you got to research. You got to analyze the financials, potential risk. Evaluate the quality of tenant. You also have to diversify your investments a bit, considering what geographic region you want to be in. You have to build a strong network, such as us, right? You got to know other investors. You got to pick their brains to see which is considered a good deal, why you would do it or why you wouldn't do it. You have to keep up with market trends, economic data. There's a lot of databases out there that show rental growth, population growth. There's a lot of free government sponsored websites. other databases that sort of combine everything that you can pay for. It saves a lot of legwork, and it's credible information that we'll share with you as well. And lastly, you have to have more of a long-term perspective. You got to see real estate more of like your nest egg per se, like your 401k.
Much better than your 401k though. We were just having a discussion about this where Ed was really just starting to try to convince me. I don't even have a 401k, guys. So he was trying to convince me. He was preaching to the choir about why real estate has worked out so much better for him than his 401k has. And so it's just one of those things, guys. I mean, some people feel more comfortable getting a paycheck and then shoving and matching your company's whatever, 8% or 4%, whatever. I don't even know what I'm talking about, but matching that and hoping and having hopium that the market somehow saves you in 20 or 30 years. But I guarantee you guys, listen, if you find yourselves good partners and good mentors within the real estate space, it'll take you far less time to get where you're going on this road than that road. And there is no hiccups on this road, guys. Listen, I don't care if there's a real estate crash like there was in 2008 or whatever. Look how well it's rebounded since then. We had 1 or 2 year lull, and then we've had 12 or 14 years worth of growth. And I'm not saying that's sustainable, but just look at the curve of how that goes versus this is the stock market. You know what I mean? Like, so don't time that. With real estate, there's no timing. This is something that Ed was clearly trying to point out to me. Like, he was almost yelling at me, and I was like, listen, Ed, this is what we do. So like, this is not to me, but to you guys. I was trying to tell you guys, but listen, there's no timing real estate. Just get in it. There's no time like today to get into real estate. There's really no better time. And especially when, like we said last episode, when people are fearful, this is when you should start buying, guys. There's some deals, especially within the commercial space. We're going to be finding properties literally 20, 30, 40, 50 cents on the dollar right now. So I encourage you guys to really study up, do your due diligence, like Ed was saying, to really study the space because it has a lot of tax advantages. It has a lot of tenant advantages where you have so much more control over your tenant within the commercial space than you do even in the residential space, because short-term tenants, try kicking them out sometimes. They may not leave. I mean, and especially a state like us, Texas, it's a squatter state. And if they choose to squat, they kind of have legal rights too. But commercial, we don't play these type of games in commercial. You say sayonara and they got to kind of leave, and they'll have their termination notice. You'll hash it out, and they'll actually owe you money if they leave early. So there's great benefits. I'm not saying one is greater than the other. They're both great investment tools. Like I said, we both own both. So it's not that we prefer one or the other, but it's good to diversify. Commercial is kind of one of those plays where if we can get into it, commercial kind of falls in line with multifamily as well. If you can get into it, we've obtained enough knowledge over the years where we are strictly looking for properties that do value add. And what that means is, guys, we're looking for appreciation plays, not only just high cash flows, but appreciation plays where we're able to identify subject properties that have lower than market rents and then stick tenants in them, new tenants in them that get our rents up to market. And that's going to shoot our cap rate up and your profit up and our profit up. And so this is strictly what we're identifying right now. So if this is something that's interesting to you guys, shoot us a comment below. We'd love to get in touch with you.
Like and subscribe. Don't forget.
Yes. Like and subscribe so we can keep putting out this content for you guys. And so that's it, guys.
Yeah.
Signing off. Say.
Ed.
Yeah. We'll see you later, guys.